Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. It's April 2022, and on this occasion I want to concentrate the discussion in this video on an aspect of inflation. Obviously, we know that inflation in many countries is moving up towards 10%, and I want to consider the behavior of house prices as part of the wider inflation process. And in order to keep the discussion manageable, I'm going to focus on the United States. Of course, I've been explaining in these videos since 2020 that the USA has had an extraordinary money supply explosion, and we're going to see how this affects the housing market as part of the wider inflation story. My first slide is of the increase in house prices in the USA on two bases. One is the annual figure, and then the other is the 3-month annualized rate of increase. These numbers are monthly. They use a so-called purchase-only index, but they're basically, they're government figures. They are basically pretty reliable. And you can see that the increase in house prices in the last couple of years has been larger than in the previous boom, which was between 2003 and 2006. And you'll also see that that boom was followed by a grisly collapse in house prices associated with the great financial crisis of 2008 and 2009. Obviously, your worries a bit about the future, but I think the point I want to highlight here is the extraordinary rates of house price increases that the USA has had in the recent past. There's no real sign of a slowdown as yet from these figures. The last 3-monthly annualized rate is 3 months to January. It's 17.5%. The annual figure is 18%. Essentially, the US housing market remains red hot. The question of why this is the case is, in my view, a fundamental one for economists. Now, an answer of a sort has been provided, a sort of quasi-official answer, if you wish, in the Journal of Economic Literature published by the American Economic Association, where in a recent issue we had this conclusion by the which I'll just read it out to you. A striking aspect of recent research in this area is a growing consensus that credit supply shifts are a principal driver of house prices. So this is a sort of view of American Economic Association that it's credit that's crucial to movements in house prices. I'm now going to look at some longer run series of data. This is a quarterly series going back to 1976. So we've got 45 years of numbers. And you can see that there was a boom in the 1970s, somewhat above that in 2003, 2006. But again, the current boom is even more dramatic than that in the mid-70s, when, of course, the USA suffered from rapid inflation and at the end of the decade from double-digit inflation. And so we need to think about, what is it that's going on here? And my own view is that we need to look not just at credit, but at money. And because there's an even longer series, which I'll soon show you, of numbers going back to the increase, not in house prices, but in the value of the housing stock, that go back, in fact, to the Second World War. And there was one year, 1947, when house prices must have risen by even more than they did in the mid-70s and in the recent past, and that was 1947. Now, the explanation that might put forward is that that was the end of the Second World War, the end of controls. But I will also point out that there was extremely rapid growth of money in the USA in the Second World War. 1943, money rose by about 30%, And so this was coming through into the housing market as peace returned after 1945. Here we've got a picture of two things: the value of the housing stock, the change in the value of the housing stock. This is all according to official data prepared by the Federal Reserve, and also the change in the stock of mortgage credit. It goes back to 1946, finishes in 2020. It's a pretty good chart, and I have taken and done an equation of that. It works, basically. On this basis, the credit side of the argument does seem to be successful. However, this is using the same two series going back to 2006, just after the last big boom, and of course leading into the great financial crisis and the upheaval in the American financial system associated with that. And on this shorter period of about 15 years, the relationship doesn't work. And so we need to think a little bit more about what's going on here, and I'm going to try and bring this all together and economics needs a good theory of asset price determination. In the general theory, Keynes proposed a view of the determination of the price of bonds. It's the so-called liquidity preference theory of the rate of interest. It's in the textbooks. Please, bonds are a very small part of the most households' assets. Houses are far more important. Equities are more important too. And I proposed, actually following Keynes's discussion in his 1930 Treatise on Money, that we can analyze the movements in the equity market by looking again at money. So when you get rapid growth of money, you get a boom in the stock market. When the quantity of money falls, you get contractions in the banking system, and real money balances, asset prices go down, and the equity market goes down with it. So I've proposed that following Keynes's treatment in 1930. But there isn't really a good theory anywhere, in my view, about the determination of house prices. I know there's this credit view I've just been discussing, but I think, in fact, that we should really think about money. We need to get this right. There's no doubt that all households, some households rent, of course, but then that house is owned by another family. The value of the housing stock is critical to people's consumption spending. Consumption is vital to the economy. Changes in housing investment are a very large part of most business cycles. So again, house prices are important to that. So we need to get this part of the subject right. I would suggest that if you're going to understand the current boom in the American housing market, the story runs like this. In spring of 2020, there was this explosion of money growth. The quantity of money jumped by almost 20% in a mere 4 months. There was then too much money chasing too few assets. So the stock market went up. The stock market kept on going up for months into late 2020 and 2021. Investors, wealth holders of all kinds, have got to balance their money against other assets, non-money assets. Non-money assets are bonds, equities, assortment of other assets like works of art and so on, but houses critically. So when the equity market goes up, when bond yields fall, that will tend to, rich people will tend to want to, equity market's too high, they sell some shares, they buy some houses to rent them out. Or they buy the shares of a real investment trust that specialize in housing. And then they buy houses, house prices go up. So that there's this constant balancing between these different asset classes and the quantity of money. And the driver of the current house price boom in the USA is again the quantity of money. The behavior of money brings us back to monetary policy. And I would point out here that there are households who've got no mortgage, got no debt. Credit's not part of the story. They're balancing money and against their housing equity. There are other investors who've got a number of homes that they're renting out, and again they can choose between homes for renting or another asset like equities, like a mutual fund or whatever. So I would explain the current house price boom by the excessive growth of money, and then, just as I would explain that in 1947, the last really extraordinary year for US houses, certainly 2003, 2006 doesn't fit so easily in my analysis, but I'd say that always we need to look at what's behaving to the quantity of money. Before I finish, I'd like to just make one very polemical point. At the moment, there are many people saying that the increase in prices we're seeing is because of what's happening to particular markets. You know, that there's the explosion in energy prices, tied up, with the problems in Russia, Ukraine. They're saying that food prices are going up, again, happening what's in Ukraine. Look, the increase in American consumer prices reached 7.9% in the year to February. That was before the Ukraine war. And please, you cannot possibly explain what is happening to US house prices and indeed the US equity market by what's happening to oil prices and food prices. There is no connection between house prices in Atlanta and Sacramento and what's happening to wheat prices and oil price. None at all. The driver of this surge in US house prices is US monetary policy and particularly the quantity of money. That's my main point in the current video. There is a lot more to say. I think the critical worry that we have to have from here is, I showed you in the very first chart how there was this collapse in house prices after the last boom. We have to worry that some kind of similar adjustment lies ahead in 2023 and 2024, and that the larger message is that this kind of volatility in house prices should be avoided, and then fundamentally, the Federal Reserve should keep the growth of money low and stable all the time, and the kind of nonsense we saw in 2020 should never be repeated. Thank you.